The U.S. Central Bank's Policymaking Committee concluded its last meeting of the year Wednesday with an upbeat assessment of U.S. economic prospects. Among them, a further decline in the unemployment rate to 5.2% by the end of 2015 and continued economic expansion of between 2.6 and 3%. Although key interest rates are not likely to rise for some time, Fed Chair Janet Yellen said it could happen sooner.
A number of committee participants have indicated that in their view, conditions could be appropriate by the middle of next year, but there is no preset time, and there are a range of views as to when the appropriate conditions will likely fall in place.
Financial markets, which had been seeking clarity on the timing of rate hikes, reacted positively, sending key indexes about 2% higher on Wednesday. We spoke with Bankrate.com senior analyst Greg McBride on Skype.
And Janet Yellen was very clear in saying that, look, this interest rate increase is not going to start anytime soon. It's not going to start in the next few meetings. So that really is music to the ears of investors who love this environment of ultra-low interest rates.
Economists say the Fed's monetary policies help fuel the U.S. recovery. But other variables could determine the timing of rate hikes, including inflation, which remains below the Fed's target rate of 2%, and falling oil prices, which Yellen says have been a net positive for U.S. consumers.
It's something that's certainly good for families, for households. It's putting more money in their pockets, having to spend less on gas and energy. And so in that sense, it's like a tax cut that boosts their spending power.
Given the continuing economic difficulties in some parts of the world, Yellen stressed patience and promised to monitor economic data closely before proceeding with anticipated rate hikes, which would ultimately increase the cost of borrowing for businesses and consumers. Arcega, VOA News, Washington.